Good morning, good afternoon, and good evening, folks, where we may be, from the UK to Australia and everywhere in between. While we're just waiting for everyone to file in, my name is Brett Evans, and I'm the Managing Director for Atlas Wealth Management, based out of sunny Dubai. Hit 52 degrees on the weekend, so summer's definitely here on the way. Joined with me by probably the best in the business when it comes to their respective fields, Ben Turner, who's the Managing Director for Atlas Tax, and Jeremy Harper for Atlas Mortgages. So both these gentlemen specialise in those areas of tax with respect to global mobility and non-residency. And obviously Jeremy with the ever building list of trying to help Aussies get mortgages and refinance and sort out their lending requirements, because the banks keep moving those goalposts left, right and centre. So we've got a good turnout today, 266 registrants across 75 countries. So we are virtually talking to the world today. As everyone's just finishing coming in now, I'll start the presentation and run you through the order of today. Rightio. As we discussed, today we're talking about three core areas. What came out of the budget, or what didn't come out of the budget, more likely. A bit of a market update on the equity, currency and property markets, and a end of financial year tips as we're rapidly approaching the 30th of June. No presentation from a regulated firm would be replete without a couple of disclaimers. In synopsis of this, pretty much says, do not take this information as personal or individual recommendations. Please treat this as informational and educational purposes only. If you do need to seek personal advice, please speak to a professional who has a license and is skilled in that area. As I'm based in Dubai, we also have, because we're a dual regulated firm, this is our Dubai equivalent of the one before, which is the Australian equivalent. Pretty much the same thing. You know, what it spells out is that we've got licenses up the yin yang to help Australian expats in the four corners of the world, and any information that we do talk about today has not been customised or tailored to your personal circumstances. So who was the Atlas Wealth Group? Essentially, we're a global firm that specialises in taking care of anything relating to managing finances for an Australian expat. We're leading provider of financial planning, tax, asset management, mortgage, anything that relates to managing your financial affairs. We are a specialist in. People don't come to us when they want to talk about Centrelink allowances or aged care pensions. We're specialists in providing dual jurisdictional advice. How does it work in one jurisdiction with the next, and those two commingling between. We've got a lot of regulators, ASIC, ATO, and the DFSA. We have clients in over 50 countries. We stopped counting because they keep moving around. So now it's just easy to say greater than 50 countries. We currently manage greater than $250 million in assets for clients around the world. And every person you speak to of a professional capacity at Atlas actually has a degree in the work that they're doing. They weren't selling used cars or carpets a week before they decided to have a chat to you. So Atlas Wealth Group is made up of a couple of firms. We've got Atlas Mortgages, Atlas Wealth Management, Atlas Tax. So what it means is when you talk to Atlas, we're able to provide a whole of wallet type of experience when it comes to making sure that your time overseas is financially beneficial. The biggest problem we often see is when you do have different professionals engaged for different roles, they don't talk to each other, and you can get conflicted advice from time to time. So what are we going to talk about today? Obviously, we've got to run through a bit of a budget summary, provide a tax update, an economic update, currency market update, equity market update, property and interest rate update, and then Q&A at the end. You'll see down the bottom, there's a box there that says Q&A. Please feel free, as we're talking, just to start typing your questions in, and we'll run through all of those at the end. So with respect to the budget, well, it's been a bit of time, well, not quite a month has passed now since the budget was released. And as I'm sure you saw from the headlines, it was a bit of a yawn event. And it wasn't so much what was said, it was what wasn't said. You know, the budget was clearly positioned and directed towards getting the government re-elected. The key message that came out of this was we want to be seen as a fiscally responsible government that has your best interests at heart. We can provide for the economy, but we're not going to engage in reckless spending. That great saying about how do you know when a politician's lying, his lips are moving, is a great example in this budget, because in actual fact, the budget was quite stimulatory, which we'll run through that very shortly. So headline items, and the funny thing is a lot of these things weren't actually enacted by the current government in this budget. These are inherited pieces of legislation or changes that were previously passed through Parliament. First one is the revised stage 3 tax cuts. Obviously, Scotty from marketing, when he was originally elected, they proposed the stage 3 tax cuts. Labor recently adjusted these, but this is not a new announcement. This has been in the works for a number of years. The $20,000 instant asset write-off threshold for small businesses, that's not a new announcement. It just means that they're actually going to extend out and build out that ability for those people to do that. So long story short, those two things aren't much of a surprise. The freeze on Social Security deeming rates for financial investments, they'll be extended. Once again, it's in place already, and they're going to extend that for another 12 months. The indexation, or the changes to indexation on HECS and help debt, was a new announcement, and we'll run through what that means for expats very shortly. So did the budget poke the inflationary bear? 100% they did. 6 months ago, Treasury estimated that federal spending was going to be around about $710 billion. And in that last week, that was revised up to $727 billion. So essentially, $17 billion extra was spent in that week leading up to the budget. $12 billion of that $17 billion it was virtue from policies that were only announced in the lead up and in the actual budget itself. So to put that another way, this week's budget estimates show a $28.3 billion deficit in the following year, but if the government had just not made those changes in that last week, it would have been only $8.9 billion. So whichever way of politics you sit, doesn't matter. As you can see, there's extra spending that is going to flow through and is going to have a stimulatory effect in the economy, much to the RBA chagrin right now. So key changes, obviously, with super. These things have all been passed through. It's coming through, but believe it or not, this is actually not thanks to the government. These are based on indexation. There's a number of key metrics that are used to determine what will happen here. So from the 1st of July 2024, concessional contributions, they will increase from 27,500 to 30,000. Concessional contributions are pre-tax contributions. So when you're working in Australia, your employer would take 9, 10, 11% of however recently you're working in Australia of your salary and put that into super on your behalf, which would then reduce your assessable income by that amount. That amount very rarely is used by expats unless you're running positive cash flow in properties, or you've had a number of capital gains events where you can use concessional contributions. And that's a conversation for another webinar, but long story short, there are ways that non-residents can use those concessional allowances. So that increase from 27.5 to 30 is a welcome sign. Non-concessional contributions, that's post-tax, that's out of your own pocket contributions, have increased from 110,000 up to 120,000. And then if you're looking to use the 3-year bring forward rule, that is, you do 3 years worth of contributions in 1 year, you're now able to do that up to 360,000 Australian dollars, and that is all available after the 1st of July this year. Changes to HECS and HELP. Obviously, last year was a big sting in a lot of people's tail with respect to that indexation of 7.1%. A lot of folks, when they do go overseas, do have a bit of apathy towards HECS and help debt, even though since 2017 the rules have changed that legally you must declare your foreign income to the ATO in order for them to provide an assessment in terms of how much you need to pay to repay down that debt. When HECS was sort of bumbling on 1.5%, not many people thought too much about it, but that 7% increase, especially with how expensive it is to get education these days, they will certainly have felt that. Now, what they're saying is instead of just going off CPI, they're going to have the option and the opportunity to be able to make it either off the CPI or the wage price index, whichever's less. So they're going to backdate this. to 1st of June 2023. And what that means is, the big question is going to be is obviously they've said they're going to refund people where there was excess indexation paid. Ben's going to actually run through the next couple of parts of it and how that looks and what he sees from the tax side when he's talking to clients who are doing these lodgements and just to provide a bit more colour, because these days it is a requirement, with the common reporting standard. The ATO does know you're overseas. They are connected in with the Department of Immigration, so they know if they don't have to look too hard to see that you're overseas. And then obviously with 150 territories and companies declaring all of those financial details that relate to you, all they have to do is do a bit of a data mine and they can go through and work out very quickly how much you have in foreign bank accounts, how much you're earning, and then you make a bit of a rod for your own back. So coming up, what I'll do is I'll hand it over to Ben, and I'll get him to run through on the tax update and provide a bit more information on the HEX debt changes. Over to you, Ben.
Thanks, Brett. One of the questions I get asked a lot is around what happens if I bring money back from overseas to Australia when I've been an expat as a non-resident. And my answer to that is always, if the taxes have been paid and your affairs are in order, there shouldn't be a taxing event from that withdrawal of funds. But one of those things that is a requirement whilst you're overseas is to make sure you're disclosing your foreign income, as Brett mentioned. And that will give rise to repayments of HEX debts on the same basis as if you were an Australian tax resident. So very relevant to people. Another thing that people don't seem to fully understand is exactly how a help debt works within the ATO system. So I thought I'd provide a little bit of extract in the bottom of the slide here, which shows how when I'm looking at somebody's accounts within the ATO, what it pops up on the ATO portal. You'll have an income tax line item, which you can see there, and separate to that is the help line item, and that will have a balance in that, and they're treated as separate accounts. And once you lodge your help, moves from the help account into the income tax account as a general debt, and that's things that you want to do or avoid doing just to make sure you don't shoot yourself in the foot there. But that's effectively the way it works from the ATO perspective. So if we were to have a look at those changes that were introduced, announced, and we're still awaiting their introduction, which is why nobody would have seen their help balances change if they've looked into it. And as Brett mentioned, the 7.1% rate in 2023, which we all would have seen, is slated to move down to 3.2%, and the 2024 rate, which is 4.7%, which only happened a couple of days ago, and I can confirm that the debts I've looked at have had that 4.7% applied to it. That's slated to go down to 4%. So if we just go to the next slide, I will show you if we drill down into one of those help accounts, you'll see how that looks, and you'll see text along the lines of this. On the left-hand side is how we would view the transactions, and to the right-hand side, I've added in what the changes would look like if you had a help debt of 10,000 in 2023. Effectively, the $710 worth of indexation would become a lot less at 334 in this particular instance, and you're going to be receiving effectively a credit of about 375. In the 2024 year, the difference is a lot less, so you will receive a smaller credit. But if you've had these transactions actually apply to you, where you can see these transactions have indexed your debt at 7.1 and 4.7 respectively, you will get the benefit of that even if you paid that off after this announcement and before it's been brought in. What they'll do is they'll bring this credit up onto that help account, which will then, when they have a fixed expiry time of say 30 days or so, that should flow through to you as a refund as long as you got your bank details on the ATO system. So that's how it should work mechanically. Obviously, we are still waiting for the legislation and this to be approved, but that's their expectation as to how this should work. I'll provide a link there as well to the help estimator, which the ATO has provided as a guidance tool. So if you're unsure as to how it's going to impact you personally, click on that link, add in your current help balance, and it should tell you how much you should be saving each year. So on to the next slide now. Brett talked about the stage 3 tax cuts, and as he mentioned, this is a revision to what was originally announced. And typically, this is less concessional than what was originally announced. What was originally announced, that whole 37% tax bracket was going to be removed, and there's going to be a very large 30% tax bracket. But they've effectively modified that so that the bracket is at 135,000 now, and they've kept the 37% bracket still in. You can see the 16% tax bracket replaces the old 19% tax bracket, so that's a win for essentially everybody. The 30% bracket, which is where the non-residents kick in because you don't get the access to the first two tax brackets, that is reduced from 32.5%. So from 1st July 2025, sorry, the starting point for tax on your investments, all the way up to 135,000 that are subject to ordinary income. So we're talking things like rental properties here or capital gains tax events. It will be taxed at 30%. And of course, no Medicare levy is applicable for non-residents. So that will typically be a relatively easy calculation for you to do. So another thing that is quite relevant to a lot of expats I speak to are people who are selling their homes whilst overseas as a foreign resident. Then what's the current lay of the land is that anyone who has a property that they're selling as a non-resident over $750,000 in sales cost will be having to have 12.5% withheld from the sales price, parked at the tax office, and then requires your tax return to be lodged to true up that figure. Whether that's more or less depends on the actual scenario, but that's the default position for non-residents. You are able to apply for a variation to have that adjusted to your actual situation and take into account things like losses or if the actual tax is going to be less than 12.5%. But the government has announced late in 2023 that they're going to expand that. So they're going to make it a lot more applicable to every home on the market. So this $750,000 threshold is going to reduce to 2.5%. Amount is going to go up to 15%. Now, this is a non-legislated measure at this stage, so we have to take it as if it was. It's likely to come in, but we haven't seen legislation yet. We've still got 6 or so months before the end of the year, and this is going to be introduced and shouldn't be a difficult thing to introduce. So my expectation is this will come in as planned. But just bear in mind that we would want to give you an update towards the end of the year once this hopefully is a bit more in force.
So I'll say here, drum roll for Ben, because everyone's waiting for this one here.
You're going to be disappointed, unfortunately, on this one.
Yep.
It's always what I'm looking intently at the budget papers, and obviously on budget night, I was scouring through those, and there was barely a mention. I think through the whole budget paper, there was, I think, 2 mentions of residency, as a keyword search. And so we've heard nothing, which is not completely unsurprising. It's true to form based on previous budgets. The word on the street is it's still quite relevant, and in the government's list of things they want to have improved. Obviously, there was the budget submission, the submissions we put forward last year to basically poke the holes in what was originally announced by the Board of Taxation. reading all the submissions that came through, there was a lot of holes, and I think to try and come up with a replacement for that, it's going to take quite some time. So whilst I'm trying to get answers from Treasury, they're not forthcoming with it. And so I think it's going to be a wait and see. My best guess is probably 12 more months before we see some sort of draft legislation at a minimum. I'd love to be proven wrong. If someone's got better intel or contacts within Treasury, you're welcome to let me know. I'd love to get a better update to everyone.
And Ben, that will depend too if who gets elected in the next election. I mean, the next election is between October this year and May next year. So if the Libs get in and they don't like the work that Labor's done with Treasury, then they could start again, and then the clock starts to gets reset, doesn't it?
It goes two ways, yeah. Obviously, you've got Treasury working on that, which are obviously a function of the government. So they, prima facie, may still remain as the group looking at that. So if they're happy with the information and intel that they've gathered through that process of the submissions, then they can come up with something relatively quickly. But at the same time, I think the latter is more likely in the sense that what you said in relation to they probably could rework the whole thing and come up with their idea. But I guess the positive thing, if that was to happen, is that it was the opposition who drove this forward from the start. So it does seem like it perhaps would be bumped up the order of priorities, so to speak.
Especially when you consider, Scott Morrison almost has passed this thing through without questioning it from the Board of Taxation, which would have been scary. So, Labor at least, issued that consultation paper last year, which is the first real outward or outreach program that the government's done with respect to the wider community, talking about what the Board of Taxation recommended. So, it does seem to be Labor has more of an interest in getting this done. Would you agree?
I'm not sure. I think, like I said, the Liberal Party brought in the initial report, and so I do think there's an interest there. I'm concerned a little bit about government's disdain, it seems, for expats. We've seen that with the main residence exemption changes, which I think we all agree are pretty disastrous for expats and don't provide equitable outcomes. But whilst I had some faith that the government was probably going to do something about that, I was disappointed, and it seems like perhaps the lack of voters that sort of exist outside of Australia when you're living your life elsewhere has dictated a poor policy decision.
Definitely, definitely. Right, mate. Well, there's questions coming in on residency, so we'll keep going on with the slides, and we'll circle back to that one on at the Q&A session. So back to our normal schedule program.
Yeah, sure. So just a couple of tips for the end of financial year. There's nothing that's sort of groundbreaking, I'd sort of say here, but obviously from 1st of July, your tax rates are going to reduce. So any deduction that is somewhat flexible on when you use it is going to have more bang for buck in the 2024 year than the 2025. Obviously, subject to your personal circumstances. I don't want you to say that's the case in all scenarios. So if you're repatriating or expatriating, then it may not be the case. But in a normal equal sort of approach, a deduction that for something that is paid in the 2024 year will typically get a better tax saving than 2025. So think about that. Obviously, we're in June now, and if people are looking to optimize their tax position and contribute to super and claim a deduction for it, the contributions need to be made and cleared within the super fund by 30 June. So that's something we're going through with a lot of our clients at the moment to work out, well, what is their optimal amount, and something I thought is quite relevant, and we've actually put a couple blog posts out on that. So looking at just explaining concessional, non-concessional contributions, and also then the process and how to determine what level of contribution might be right for you and how to go about that. So look out for that on our LinkedIn, or if you're, it's on my post that I put up today as well. So look out for that.
Yeah, we'll
The
get
other
that
thing I
shared
think
amongst all the channels as well.
Yeah, great. The other thing I'd mention is that the ATO is focusing on a couple of key areas this year. It's always good to know what they're looking at. One of the things is work-related expenses. Now, typically with expats, we don't see too much in the way of work-related expenses unless it's pre-departure or someone's repatriated, because most of their income they're earning will typically be exempt if they're non-resident. But one thing we do see a lot of is rental properties. And the ATO is sending out notices to a lot of people, sort of putting them on notice that we're looking at rental properties this year. They've sent letters out to a lot of my clients to say, you know, we're looking at this, to sort of scare people to make sure that they're doing the right thing when they're claiming their costs. Some things I've seen pop up in various forums that I'm on. You know, some people still think that if you travel back from overseas and have a look at your rental property, then all of a sudden your flights and everything and accommodation can be deducted in your tax return. That stopped in the 2017 year, where it used to be okay. It's not anymore. So I'd be very cautious of anyone trying to claim these thousands of dollars of travel costs when they're looking at their rental property when coming back to Australia for a, you know, what's otherwise a private visit. That's pretty much the key items from me. So I'll reserve any questions for the Q&A later on, and I look forward to hearing from you.
Cheers. Thanks, mate. So, folks, I promise I won't bore anyone senseless. Talk about the economy is not exactly the most exciting topics, but I'll try and make it interesting and relevant. So, running through, where did we see the Australian economy going? We actually saw the GDP figures come out today, not looking the most rosy of the pictures, and it's sort of at odds to the numbers that the RBA and also to Treasury have released as part of the budget. So they've indicated obviously an expected surplus. This has all been driven by high personal tax income receipts as well as commodity prices, due to a number of reasons: rising unemployment, falling commodity prices, and a slowing economy. No one sees a surplus for the next at least 10 years. So I won't say the good old days are gone, but they're not going to be around for the short to medium term. So Treasury forecasts suggest the Australian economy will remain weak with the forecast period and only start to return to rates of economic growth similar to what we've seen in the past in 2027-28. Today's number would certainly ratify that as well too. The current weakness in the domestic economy is largely due to flat household consumption and falling dwelling investment. Talk to anyone in retail back in Australia right now, it's a bit of a wasteland in what's going on. So the punters have really pulled their purse strings in. Strangely, we're seeing like a three-speed economy at the moment. So I wouldn't say it's across the board in all consumer discretionary categories. Certainly consumer staples okay, but consumer discretionary, some areas people are choosing to stop buying, in other areas people are still choosing to purchase. So we are seeing that sort of settling out process going on right now. But long story short, the Australian economy, where is it right now? It's bumbling along is probably the most technical term I could use that people could relate to, because it's not shooting the lights out, that's for sure. Inflation is the big concern. So inflation forecasts contained within the budget show a pathway to return of a target inflation band that is significantly different to what the RBA is talking about. So according to Treasury, they're saying inflation of 3.5% in 23-24, down to 2.75 in 24-25. This is, I wouldn't say fanciful, but it's certainly an extreme view that if the government is wrong, then the implications for the cash rate to stay higher for longer, that we could see higher mortgage prices going forward. Just in terms of when's that next rate cut going to be? We've seen a lot of conversations going on right now regarding economic data coming out of Australia. And to me, I think definitely the Treasury and to a lesser degree RBA are painting as rosy a picture as they can, given what the data is saying right now. You'll hear a word that all the central banks use around the world. They're saying they're data dependent. So what they're trying to say is they're taking emotion out of the decision-making process. And when the data says X, that's the causal event for them to make a change. Biggest concern we have right now is how, obviously, as expats, what's going on with the currency. The currency market right now has been quite favorable for pretty much all expats, depending on what currency you're earning. But I'd say the vast majority have enjoyed the last couple of years with the dollar where it is. And as you can see there, the only real currency that the dollar's strengthened against, the Australian dollar that is with respect to the Japanese yen. So for those earning income in Japan, apologies, but for the rest of us, it's been quite a good run. And people are seeing that as an opportunity, repatriating capital back to Australia, whether it's for buying property, putting money into super, building a share portfolio. It does have a lot of benefits. And we don't see a major change in the short to medium term based on where it is right now. The reason being, there's two main catalysts that drive the Australian dollar: interest rates and commodity prices. If commodity prices go up, therefore the Australian dollar is worth more because there's more people in there buying the Australian dollar in order to purchase our iron ore, our copper, rare earth metals, and all those sort of things. The other one too is interest rates. So if we have a disparity between what the RBA sets the official cash rate and, say, the US Fed or the European Central Bank or the Bank of England, then people can chop and change currencies to try and chase that yield. What can happen is the Reserve Bank can leave interest rates unchanged for the next 12 months. But if the US Fed increases their rates, then people are going to want to buy US dollars in order to chase that higher yield. And conversely, if the opposite happens, Australia holds their rates and US cuts their rates, then that will make the Australian dollar more appealing to investors, and we'll see the Australian dollar strengthen on the back of that. We saw at the beginning of this year, and I thought this was a bit of a storm in a teacup, but no, obviously it was a big deal in the first quarter. The market was of firm belief that there's going to be interest rate cuts by the US Fed in the first or second quarter of this year. Inflation has proven to be incredibly sticky, and by virtue of that, we haven't seen a rate cut, and nor do I think we'll see one. Especially in Australia, when you look at the RBA numbers, they're now calling no rate changes until 2025. Now, where the fly in the ointment is we have inflation being very sticky. And when we looked at the trim mean numbers for the first quarter of this year, normally, and this is the RBA rulebook, anytime that quarterly trim mean inflation number is 0.9% or greater, they raise rates. When that first quarter number came out last month, it came out at 1%, and the RBA didn't lift rates. So, of course, there's a lot of people out there that talk about the lack of independence that central banks have now with respect to influence from politicians. Where that's the case, we're not going to get into that today. But what it means is, for the first time in a long time, the RBA broke ranks from their rulebook. So Michelle, she's the head of the Reserve Bank. She's been at odds with a lot of folks at the moment because the numbers are telling us X, but she's doing Y. And what she's trying to do is not cause any more, hurdles or handbrakes on the Australian economy than she has to. So the next quarterly number, Q2 number, comes out in July. And that's where it's going to be interesting to see what happens there. If that trim mean inflation number is at 0.9% or greater, and they don't raise rates, then we know that there's something broken in the system, because that would be the second time in a row in the RBA's history that they haven't actually followed their rulebook. When we look at the cash rates right now, we're sitting at 4.35%. And historically, they're actually not that high, to be honest with you. What's causing the issue is people's gearing, and the amount of debt they're holding in life is a lot higher now. So when you look at, say, a person buying a property in Australia, they're spending 8 times their salary, whereas 20 years ago, it was 3 to 5 times their salary. So a lot more of their income is going towards servicing this debt. That's why they're having these sort of issues right now. When we look at those numbers, and this is where I go through in a bit more detail on the trim mean. So RBA forecast, assuming they remain where they are, and then they fall to 3.8% by the mid-2026. I've been given a lot of articles by a lot of people talking about rate cuts, in the third quarter of this year. I think if we get a rate cut in 2024 at all, I think that's lucky for mortgage holders, but I can't see it happening. Depends on what these inflation numbers look like. Now, the reserve banks around the world are really grappling with this. It's not just Australia, and they're finding a lot of issues in trying to manage this. So commodity prices, what are they doing? Now, we had a really big boom, obviously, in commodity prices through the 2023-24 period. As COVID, the borders started to open up, more goods and services were flying around, and obviously commodity prices strengthened on the back of overseas demand. As you can see on that chart on the right, iron ore, thermal coal, and coking coal all had big spikes, but they are moderating now. with China being the key one. Obviously, they're a large consumer of our iron ore and also to our thermal and coking coal as well too. So the big question is going to be on this is what's the Chinese economy going to do? The Chinese economy will in turn dictate what happens with commodity prices, and that commodity prices will in turn dictate what the Australian dollar is doing. So coking coal prices collapsed. That was a recovery of supply. Things normalised, obviously, when China started to accept Australian imports, coal imports again. That settled things down. Up until that point, Canadian coal producers were almost getting double the price for their coal. So they were making off like bandits while China could not buy coal from the Australian government or the Australian economy. But now what we're starting to see is those prices are now starting to moderate. Improving steel margins and rising steel output have lifted iron ore a little bit by about $10 a tonne. They've picked up off their lows. The inventories in China are picking up in terms of iron ore inventories at the ports. So the big question is going to be is China's trying to fire up the economy again. Obviously, China, like Australia, is very heavy in that property investment sector. In terms of being part of the economy, and with China, what they're going through right now with Evergrande and other assets, they're having a real problem with that. And obviously, if there's not a lot of new buildings being built, obviously that demand for iron and steel does decrease. The big question is going to be is can they kick off infrastructure projects to try and fill that gap? On the equity markets, it's actually been, surprisingly, given that the environment we've been in, quite a favourable environment. As you can see here, these are numbers as of budget night. ASX 200 up 7.62% for the year, S&P 27%, and the FTSE's 8.69%. These sort of charts show the importance of diversification. Most people say, "Oh, I'll just go straight into the S&P 500," and what you don't see is about 5 days later, the S&P fell by almost 7%. So whereas the ASX and the FTSE didn't. Also, these are reported in one currency basket. If you're invested in these different assets, you are going to be exposed to pounds, Australian dollars, US dollars, and those different currency movements will also act as a shock absorber on both gains and losses as well too. But overall, it hasn't been a bad period, especially when you consider everything we've been going through, the fastest increase of interest rates in modern history, combined with the Ukraine invasion, combined with the conflict going on in Israel and Palestine, and everything else that's been going on as well too. So the market, the message that comes out of the market consistently, while people do talk about, sort of a bubble being formed, is things are fairly priced. And that's what we're actually seeing coming out from CEOs. CEOs being very careful in the guidance they're providing, because when you give guidance, forward-looking guidance on a company, investors will hold you to that guidance. And if you can't live up to it, you've just lost your job. So CEOs are being very conservative, but the good thing is, and as we've seen with the December 31 results that were released in March and April, and also to the 30 June results, which will be released in July and August, companies are actually living up to expectations. They're not killing it, but they're actually being going well. What skews the S&P 500, obviously, is 60% of that is now tech. So when you look at the actual weighting with the size of the companies, and then you've got companies like NVIDIA, Qualcomm, and all those sort of companies that are the latest market darlings that have really pushed things up. So how should you construct your portfolio in this type of market? And it's a question we get asked quite a fair bit. And to be honest, when you take a thematic approach to managing money, it sort of simplifies it a bit more. It's going to be a combination of a currency play and a sector play. So there are certain sectors that do well in relatively high interest rate environments, and there's some sectors that do very poorly. Sectors that perform well, financials, and I will add there is a caveat here, which I'll cover in a second. Energy sector, healthcare sector, and utilities. Sectors that are vulnerable, tech, believe it or not, you never know that because tech's one of the best performing sectors at the moment, but it's not all tech that's doing very well. It's just particular tech companies that have an AI bent on that. Consumer discretionary, obviously, if you're doing it tough, you're not going to buy a Louis Vuitton handbag. So that discretionary side of spending certainly curtails, which we're seeing right now. And then the construction and real estate, obviously we're seeing record insolvencies and bankruptcies with the construction sector in Australia occurring as we speak right now. So here's a bit of analysis, and I find pictures are an easy way to describe the concept. So this is not from us, this is from Schwab, Charles Schwab, and it's essentially a measure of the S&P, the index performance based on the sectors relative to the first rate hike of the federal central bank by the US Fed over the past 5 years, in 1994, 97, 99, 2004, and 2015. So as you can see there, energy has had its best run. And if you go and look at energy stocks right now, they are having a very good run. IT, financials, healthcare, comms, and also utilities. When we go through and look at the numbers, the exception is Australian banks. Now, while Australian banks hadn't been doing too badly, when you consider them and compare them on a global scale against other banks, but also to other asset sectors, they're actually having a hell of a time. And Jeremy's going to run through this in his property and mortgage update. But essentially, right now, it is the toughest markets that banks have ever faced in I wouldn't say the history they've been in, but certainly in modern history anyway, in terms of new loan growth and new activity. The net interest margin, which is how banks make their money, is essentially the percentage difference between what they borrow at and what they lend at. That amount in between is what they make. So anyone out there who has their own business, can you imagine running your business with a 1.9% net interest margin? It's crazy. So the way they do it is they have very, very large loan books. The problem with that is banks tend to do very well on their loan books when interest rates rise, because there's more spread in the margin. And then when interest rates fall, it gets narrower. However, what we've seen is quite different at the moment, because when interest rates rose from nothing up to 4.35%, what actually happened was their net interest margins went down. As you can see, it was a brief hiatus as they started to trade off margin to try and get new business. Jeremy run through, sort of some of the shenanigans they've been pulling in terms of not rebating sign-on bonuses and refunding fees, because essentially they can't afford it. That's how tight the banks are right now. So I'll hand it over to Jeremy now, who's going to run you through the property market update and also talk about interest rates as well too. Over to you, mate.
Thanks, Brett. Okay, so just firstly talking a little bit about some of the headwinds that we can see in the near future around the property. So obviously with the updated budget, a hot topic at the moment has been immigration numbers. So just purely from a property conversation, there's more people coming to this country than we're actually building dwellings for them. So that's putting a huge demand on the demand for rentals and for properties. So you're seeing that flow through in some of the numbers, which we'll get to a bit later. But one of the forecasts that the Treasury released was they forecast a decrease of the immigration numbers from 528,000 to 260,000, which I think is quite, I guess you'd say, optimistic to see if we can get there. And secondly, they've introduced some caps around with the universities around providing adequate housing for international students. I think the hope around that is to take some of that heat out of those inner city markets where some of those universities are, where some of those international students are competing for some of those rentals, which we're starting to see, with those low vacancies in terms of the rentals in those areas. Some of the other headwinds, in terms of the arrears for the loan book, we've got some numbers there from ANZ. Keep in mind, this is coming off still quite a low base in terms of the arrears, but we have seen an uptick in this, and particularly as Brett was saying earlier, around where the expectations now that particularly with the high inflation numbers from the additional spending from the budget, rates could stay at higher for a longer period of time. So that's going to start to continue to impact Australian households as they're starting to continue to feel that pinch around that higher mortgage repayment compared to a couple of years ago. So if we go across the page, some of the main drivers for Australian property prices. So interest rates, as we've discussed, access to capital. So access to capital, we've got a sheet on that shortly, but if we think about for expats and also for people based in Australia, with where rates are sitting now, when you go for a new mortgage, it is quite conservative. It's quite hard to actually take out a new mortgage right now because there's still that 3% buffer on that proposed mortgage. So with rates sitting at 6.5%, you're going to have to qualify at sort of 9.5% on that new mortgage. So the ability for people to actually get that access to that additional capital is very difficult at the moment. And we're seeing that in the market. We've actually, in overall mortgage demand is down about 20% year on year. And that is a function of people not being able to actually access this capital. and then supply and demand. So if you look at, in terms of what's happening in some states, so if we've got some data later around what's happened in Victoria, you're starting to see there's a little bit more supply coming on the market, a little less demand. So they're the three big drivers there. So across the page, so this really shows us that, coming during COVID, there was a real demand there, particularly around business and housing lending. So this is credit growth per sector. From the business point of view, that was really demand required. So that was, businesses going into shutdown mode. They need to rely on lending to get through that COVID period. And as obviously we're post-COVID, that demand has started to drop off with business lending. But one of the challenges on the business side is with obviously higher rates for longer, that is now really starting to impact businesses going concern, and you're starting to see some businesses and some industries start to wind up, particularly sort of hospitality and construction. On the housing side, you're starting to see the demand for particularly some investment lending in some markets has come off. And as I said before, the demand overall is about 20% down on the prior year. So supply and demand, this is talking more around the building of new dwellings in Australia. So we had the Housing Accord made an announcement to say that they anticipate 1.2 million new dwellings to be built over a 5-year period. And even the experts from the building industry said that that's quite a aggressive target, and they don't think we'll get there. And from my point of view, working with customers at the moment, either looking to do a full new build or a renovation, it's incredibly difficult. I haven't seen these conditions as hard as they are right now. Builders are coming back to clients at the moment, asking to sort of reprice on the build. The cost to deal with council or to get it all approved, all of that has actually gone up well above what they're budgeted for. So from my experience, what I'm seeing on the ground is it's very hard to get these new builds completed and started and actually funded. I've had clients who have walked away from the idea of building a new investment property, and they've just decided to sort of settle on the land and potentially sell that land in the future. And there's even stories of developers who have actually had their products or their projects approved, but because of the feasibility of the actual project, it doesn't make sense with the higher rates and the higher taxes. So you're now starting to see here the actual approvals and the investment start to drop off. So over the next page. So if we go to the next page, we're going to talk a little bit about the sort of where house prices are and clearance rates. So if you look at on a metro from a city basis, we are starting to see a little bit of a separation between some of the major cities. So Melbourne has been, I guess, the clear underperformer over that 12-month period. And even if you look at year to date, they've actually gone backwards in comparison to its peers. I think a lot of that's driven by some of those tax changes we've seen in Melbourne. So they had a big change around land tax, which is basically impacting most investors. And there's also been some quite aggressive changes around tenancy laws down in Melbourne. So from my experience, I'm starting to see some clients really review their position with their properties in Melbourne, and start to potentially put those on the market and exit that. Whereas conversely, you're seeing some other cities like Brisbane, which is continuing to power along, and same with Adelaide, where there's real value there compared to a lot of investors coming out of Sydney, taking their Sydney money and looking at some of those other cities where they represent a little bit more value for their dollar. So across the page, if we look at the clearance rates, as I was saying earlier, Melbourne, if you have a look at the listings that have gone to auction, so you're seeing quite a bit of stock going through the market, but the clearance rates are holding up, which is quite surprising. So there's still demand there for homes, so they're still exchanging. And I think what we're seeing here is a little bit of changing hands from investors in Melbourne, particularly into more that owner-occupied, particularly some of those first-time buyers getting into the market in Melbourne. And you can see there with Sydney, clearance rates at that 72%. It's holding in comparison to sort of last year as well. So what I want to do here is just put together a little bit of a update around with the tax changes or the tax cuts that are coming through 1 July. What is that going to represent in terms of your borrowing capacity? And I guess the short answer is not a great deal. It's probably about a 5% increase in your borrowing capacity. And a lot of that, if you think about it, just from a living expense, when we do a mortgage application, obviously we look at your income and then your net after tax income, which is what's driving here, but also your living expenses. So on the background over what's happened with the living expenses in terms of the minimum the bank supply of the last 12, 24 months, that's increased quite significantly, which is actually decreasing at the market's borrowing capacity. So we're clawing back a little bit of borrowing capacity, but yeah, 5% for sort of an average single person on 100,000 or someone, with a family of four earning a $150,000 taxable income. And across the page, so Ben talked earlier about the changes around HEX and how that's going to impact the inflation indexation on what's going to get charged on what's outstanding on your balance. In terms of how it impacts your application and your borrowing capacity, not a big change there. So you can see here, thought I'd put this table together just to show you how aggressive that repayment rate is when you do start to earn, you start to climb up in terms of your taxable income. And what's really important to understand is the repayment rate is based on your taxable income. And so that is what's applied on your mortgage application. So for people who have quite a small HEX balance outstanding and they're on a higher income and they're looking to increase their borrowing capacity because they need to, maybe they're looking to buy an investment property, the numbers may work out that you need to perhaps pay out the balance in full on the HEX to get that increased borrowing capacity. So just keep in mind that, let's say you had $5,000 outstanding on your HEX. If you go ahead and pay $4,000 on that, it doesn't change anything in terms of your borrowing capacity. It has to be paid out completely. So it's either all or nothing. And you see that with these aggressive repayment rates, it does make quite a big difference in terms of how much you can borrow. So in terms of interest rates, so as we said earlier, with the high inflation, there is that expectation that rates may be higher for longer. But this is just a snapshot of what I got from a CBA presentation from last year. The largest lender in Australia. This shows their portfolio of fixed loans. And what's really interesting is if you have a look at, yes, there's a few periods that have already transpired, but if you look at out to June 2025, we still have quite a bit of fixed rate loans. So locked in at that super cheap sort of 2%, 2.5% interest rates that are still to mature. So there's still clients out there that are still on those fixed rates that will be there for the end of this year up to June next year. So from a market point of view, we still have quite a bit of mortgage holders out there that have not had to adjust for these high interest rates. So we've still got people that are waiting to go from a 2% mortgage to a 6.5% mortgage. So there's still a bit to play out there in the general market. And if you go across the page, this sort of ties in with that earlier CBA breakdown, where you can see there that on the left-hand side, the variable rates, which is customers that are on an existing or a new variable home loan, essentially that is there's no difference between an old rate or an existing rate, because that works in conjunction with the RBA. And you can see that's gone up over the last sort of 18, 24 months with the RBA. But on the right-hand side, you can see they're the fixed home loans. So they're the outstanding loans in that sort of purple. We can start to see those outstanding loans are starting to jump up, and that's representing customers that are rolling off those super cheap 2% fixed loans down the bottom, and for the customers that are starting to roll into higher fixed rates as they start to mature, if that's what they want to do. And you can see there with that orange, the new loans, customers that are fixing fixed rates now, they're now close to that 5.5%, 6% for a new fixed rate compared to what they were locking in 2020, 2021, where it's down at 2%.
Try again.
Over.
Thanks very much, Jeremy. That was a great little synopsis. And now's the fun part, folks. Now you get to hold the torch to our feet, and get those answers that you've always been doing. So the questions are coming in, which is fantastic. So now's your time to chuck them into that Q&A box, and we'll run through them one by one. Just before everyone runs off, a bit of housekeeping. Like this webinar, we do a lot of things for expats in terms of information sharing, advising, you name it. For us, the educational component is just as important as the execution component. So to try and make your job as easy as possible when it comes to managing your financial affairs overseas, we do, in addition to seminars and webinars, we also have these podcasts as well too. So if you do like podcasts, even if you don't, you can actually watch us on YouTube, so that you don't have to be a podcaster to be able to enjoy it. But we do have two channels: the Australian Expat Chat podcast, which is available on all the major podcast channels. We also have the Expat Mortgage podcast, which primarily relates to property, finance, and those sort of things. Also available on those channels. And last of all, we have our Facebook group, the Australian Expat Financial Forum. There's about 3,000 or so people in that group now. So, and if you want to be part of an ecosystem where there's a lot of discussion and engagement with respect to how to optimize your time overseas, then please, by all means, jump into there. So, guys, let's get the Q&A on the road, and I'll moderate and I'll throw questions to the panelists, and we'll go from there. So, first question I'll actually cover off on. Ben, I know you responded to this in the panel, but I'll ask you just to repeat that online if that's okay. So, anonymous attendee says, does the HEX change apply even if you paid it off before the last indexation?
Yeah, so if you had a help debt, HEX help debt, as at 1st of June 2023 or 1st of June 2024, they're the dates that they're applying the indexation. If you had a help debt on either of those dates or both of them, you would benefit from these changes, and you'll get the benefit regardless of when you pay off that debt. So that's the answer to that.
Fantastic. And next question to you as well, Ben, but I think everyone knows the answer to this one too. Can I do negative gearing on my rented property if I work overseas and are considered a non-resident for tax purposes?
Yeah, absolutely. The rules don't change on an Australian home. If we're talking about an Australian home, then yes, it will continue to apply tax in Australia as normal. Negative gearing doesn't work so well when you're a non-resident, because often you won't have Australian income, taxable income to offset that against. So any loss that you generate accumulates over time and is then used up if the property then switches around to become positively geared, or if you make a capital gain, then that would then be offset. But most investment income falls within withholding tax and won't normally be able to offset that directly. Also, things like help repayments, that they won't get offset by a negatively geared property. So you want to make sure that it does work in your circumstances.
Okay, fantastic. And I think there's also a phrase that we always gets banded around, which is incorrect. And I think you'd agree with this one. People talk about accruing tax credits because they're running a property at a loss in Australia. They're actually not accruing tax credits, are they? They're accruing income losses, which is two very different in terms of the categorization of those sort of things.
Yeah, that's right. It's a tax. So it's a revenue loss, which is then carried forward and then used up once you have revenue, once you have the taxable income.
Fantastic. Okay, Jeremy, one for you from John. Any changes to lending policies that will help Australian expats get a mortgage easier?
Yep. So this is changing all the time. So lenders come in and out of this space all the time. So it's sort of quarterly, depending on their internal risk. And I think a lot of it's driven by APRA as well. So some small lenders have come into the space and they've had to pull back out, then they'll come back in. But yes, there's been some positive changes recently, and I think that's going to be the trend. So, some banks have started to go up to sort of 80% LVR for some lenders, even a little bit higher. Some can go into LMI. A lot of it would be driven by the currency, your income, and serviceability.
Fantastic. Nathalie, this is all talk. There is election coming. Nathalie, you are spot on. It has to happen. It always happens in a government timeframe. In terms of when it happens, it's up to the government. They can either be as early as October this year, or as late as May next year. If I was a betting man and I've been known to, play a bit of two up on Anzac Day, I would say it's going to be before Christmas this year. And the reason being is with the way the economic data is going right now, inflation being sticky, the economy is slowing, interest rates, the cuts being pushed back. Would you want to be a government trying to get elected sooner than later? It's sooner being the economic platform is better than it is later. But then again, politicians do strange things for strange reasons. But you're right, there is an election coming, but it will be between October and May next year. I know someone was talking to me the other day about how Queensland's got an election coming up. So apparently you can't have it within a certain time frame of state elections as well too. So that might have a bearing on when they do it. Might be November. I don't know. Who knows? But the only people know right now is Albo and his crew. And we'll watch that one closely. Question from Bernard. Has the CGT rate changed for overseas residents selling property? Ben, do you want to take care of that one, mate?
Yeah, sure. So CGT is not actually a separate tax rate. CGT is calculated on a particular basis, and then the net capital gain is treated as ordinary income and taxed at your marginal rate. So in effect, any capital gains is affected by the changes in these rates. So a capital gain that's taxable after 1st of July is going to be at a better tax rate than on 30 June.
Fantastic. Actually, we've got someone here too who's put their hand up. So I'm just going to let this person talk and ask their question. So, Carsten, you put your hand up there, mate. Do you want to have a quick chat and ask the question?
Actually, I think I did that by accident.
Okay.
But I was just typing the question actually in the chat as well.
Okay.
But basically, my question is, whilst I'm speaking now, I'm considered a non-tax resident, but of course that's always a little bit with a question mark. And my question was regarding the super contributions Ben mentioned before, whether that's still something I would actually be able to do, or whether that would be something to be perhaps a little bit prudent with and avoiding to have those financial ties or whatever construed by the ATO. So that was the question actually. I was trying to type in the chat, but I pressed the wrong button.
Not a problem. Not a problem, mate. Thank you for the question. I'll hand it over to Ben to answer that because he actually wrote a blog about it yesterday. It went up on our website about can you or can you not. So over to you, Ben.
Yes, exactly. Yeah, so definitely from the answer of can you, yes, you absolutely can. Whether you want to depends on a range of factors, and I would refer you to that blog post because it goes through a range of different scenarios. But effectively, a concessional contribution where you're claiming a tax deduction only benefits you if you've got taxable income to offset. A non-concessional contribution is where you don't receive a tax deduction and is useful in the case that you want to just build up your super balance. So that's preferable for people who are looking to just build up their balance towards the end of their working years. The second part of that question, which I'm assuming you're alluding to, is the residency part and whether that impacts your Australian tax residency. And that is mentioned in that blog post as well. My view is that it should not impact your tax residency unless the contributions were such that you were effectively foregoing a particular lifestyle in the country that you're in, where the tax office could spin an argument to say that you are really just looking to feather your Australian nest and you're actually just working in one place, but really still living in Australia. So in that scenario, there would have to be a lot of other factors to point towards residency before that would be a concern of mine for the contributions to super.
It'd be things like having spouses, dependents, lifestyle assets like cars, all that sort of supporting evidence, I guess you could say. Okay, fantastic. Right, on to Ian's question. If I plan to return to Australia, is there a CGT advantage or disadvantage from selling the Australian family home as a non-resident prior to returning, or waiting to return and take up residency, understanding what you said about the expected 1 Jan 2025 change for non-residents? So I think obviously we're talking about a couple of issues there. He's talking about Australian family property, so you assume this would be a form of PPR?
Yeah, I mean, if it's your main residence, then there is almost no scenario I can think of where it would benefit you to sell as a non-resident, because you effectively don't get the main residence exemption. But as soon as you step foot into the country as a resident and sell that, then there is at least typically a percentage available to you for the time that you lived in it, and also some time after you started renting it out. That could typically be treated as your main residence. So there will be percentage likely that that would then be not subject to Australian tax. I couldn't think of a scenario where selling as non-resident will get you a better result than you waiting to come back to Australia and sell it. Is a short answer. Obviously, you need to consider all scenarios based on someone's personal circumstances, and there may be some, but I can't think of any off the top of my head where you'd do that. The 1st of January changes is talking about the withholding that's associated as selling as a non-resident. So you just need to bear in mind that's just a withholding amount. So that goes into a bucket with the ATO to say this is tax withholding. So to make sure you do your tax return, you recognise the capital gain or loss associated with that property. And then if it's all due back to you, we'll just refund the whole lot. If there's more due, we'll tax you on top. If the assumption is you're going to be a good taxpayer and lodge your tax returns, then it's a timing issue only. It's not an actual impact, but obviously timing issues where someone's withholding hundreds of thousands of dollars of your income, of your proceeds from the sale, could be a significant issue to you.
Definitely. Question from Lisa. I'm in the process of selling our primary residence in Portugal, where we've lived for 10 years. We are Australian and Portuguese passport holders. We are considering returning to live in Australia and leaving our home to sell. Please advise on the capital gains that we may need to pay in Australia if we are residing in Australia when we sell our home in Portugal. Obviously looking at deemed acquisition sort of event there, Ben.
Yeah, there's a lot of things to consider there. So, if it's your primary residence, it still can be your primary residence if it's a Portuguese home and you didn't have any other permanent place of abode or principal place of residence in Australia or anywhere else in the world. So it could be that it's completely tax-free even if you sell it after you come to Australia. You'd need to work through the specifics of the transaction though, just to be sure. But the second part of that, please advise the capital gains we may need to pay if we're residing. So effectively, most assets that you've got from overseas when you arrive in Australia, you get deemed cost base as it's like you bought them on the day you arrive for whatever market value that they're on, and it's only gains from that point on that you are taxed. It does depend on a number of things. If you were in Australia prior and you bought it then, and then you didn't deem dispose then you don't get deemed acquisition when you come back. So I just want you to be a little bit careful of the nuances associated with that.
Yeah.
But typically that's where it can typically apply, as well as the main residence exemption is something that may be applicable, but we need to work through the transaction to actually give you a proper answer on that. But it's there could be some very positive tax outcomes in that scenario.
Yeah, well said, Ben. I think that's the thing. If you move to Australia and buy a place, then that complicates things. If you move to Australia and rent a place, that gives you another scenario. There's a lot of moving parts of that. So, but now thanks for answering that question, and thanks for your question, Lisa. Khaled asked, would Victoria reconsider the land tax changes since it is affecting property market negatively? Jeremy, do you have a thought on that?
Well, I mean, the Victorian government is broke, so they need to find
Yeah.
they need to find it. They need to plug that hole. So what an easy way. It's a bit of an easy way to go after property holders. This is a new change, so I think they will review it in a couple of years. I believe it was under the guise of a 10-year COVID repayment plan.
Yeah.
So, but we all know once a tax is in, it's very hard to wind back. I think this would be the only way it'd get reconsidered is probably taking it to an election, and if it's something that the opposition make it something that they'll repel or go after or adjust. But I can't see, not in the short term, but it's definitely having an impact. If you look at sort of down the Mornington Peninsula, where a lot of people have those second houses, they started to offload them. So there's a huge amount of listings down there because people don't want to get caught out in some of these changes, particularly around this absentee tax, which can
Yeah,
be quite
4%.
expensive.
4%, is it?
Yes, I believe that's right.
Yeah.
4%. So I think people are very mindful that they're quite aggressive, the State Revenue Office, and so people are just mindful around, how can they plan to avoid this. So I think it'll be take to an election, really.
I agree, and it's like that case of when the government says we're going to build a bridge and we'll charge a toll to pay for the bridge, but then the toll's still there 10 years later, paying for the bridge that was
Yep.
paid for previously. So, and reminds me too of when GST came in and the states were meant to stop charging stamp duty, yet they still kept charging stamp duty and we're paying GST. So we'll see how that one pans out. But Carla, to answer your question, unlikely, but put in your calendars 10 years from now and see how close Jeremy was. Question from Michael. Current rules for deemed tax resident, question mark, 180 days. Look, it's a lot more than that. Ben can run through what the current 4 tests are. But yes, Ben, do you want to take one from there, mate?
Yeah, look, the short answer is 180 days shouldn't be considered as the be all and end all. 183 days, I think you're alluding to as one of the tests. There's 4 different tests. You only need to satisfy one of those to be a resident. It's quite easy for a citizen or a permanent resident to retain residency. Normally, the physical presence in Australia is a lot less than that. There was a case that came out earlier this year where someone was averaging over 5 years, only being in Australia about 50 days a year. He was deemed a resident based on broader circumstances. But you do need to consider a whole range of different things. Don't think 183 days will definitely make you a resident. It was largely considering what you've got outside of Australia, what you've got inside, what your ties are generally, and also the country that you're in as well can make a difference as well. So not an easy blanket answer we've got on that question, which is why we're looking to change the rules so that there is that bright line so that people can have some certainty without having to hire someone who's goes into all the case law history to be able to give you an answer.
Get rid of the grey and bring black to black and white. So, question from Natalie. Another one for you, Ben. Is it true audits from the ATO are 2 years behind?
I wouldn't be surprised. I haven't seen a lot of audits lately, but I don't have a contact in the ATO that's told me where they're at with that. So I wouldn't be surprised at all. What I'm seeing is that things are taking a lot longer than what I normally have expected over the last 20 years I've been working in the industry. It seems like the longest delays I've ever seen to get things done, and especially trying to get to a tax specialist, which is typically everything that we do has to go to a specialist team to get an answer, and I'm finding it almost impossible to get the right person on the phone. So yeah, I wouldn't be surprised. The short answer is I'm not quite sure. I'd like to know what the ATO is doing about it if they're looking to hire people, but I'm assuming there's a whole bunch of people retired and haven't been able to fill the void in that. It does take some specialty to be a tax auditor. But I don't want people to sit on their hands. They're getting smarter with things like AI and picking up flags. And so, to the extent that it affects expats, things like, where you've got car registrations, where you've got house utilities in your name and your movement records through immigration are all flags that we know the ATO has access to, and it wouldn't take too much for people to put that together as to an audit flag.
Definitely. Okay, good, thanks. Another question, does the 6-year CGT exemption on temporary leaving your PPOR remain unchanged for residents and non-residents alike? I'm assuming they're referring to main resident exemption, the 6-year rule. It's often quoted.
So it's still applicable. The key factor is you need to be a resident at the time of sale for that to be relevant. Otherwise, the main resident exemption typically isn't available except for very, very minor life events, very rare life events. So if you are non-resident when you sell, the 6 years you basically throw that out the window along with the rest of the time you lived in the property, and the whole thing becomes taxable. So normally very poor outcome if someone sells whilst non-resident if they've held that property for some time and it's appreciating in value. I know a lot of people who have come back to Australia resume residency before selling their property.
Yep. No, well, so it's all about the specifics. MRE is still there. It's just eligibility is what matters at the end of the day. Question from Sean: are there any crypto-related implications in the new budget? I'll throw it to either of you for that one.
Look, there was nothing that was seeming to be a change in the tax law or anything like that that I could see. You know, so nothing that I would say is worth mentioning.
Okay, easy one. For Marie, I'm an Australian living in Germany. My father died, leaving our family home to myself, my two brothers, who are both living in Australia. She doesn't go on to say what the question was there. Oh, here we go. We are wanting to sell the house, but I'm not sure how that all works out with me being an Australian non-tax resident. The house was built back in 1967, and my father and family always lived there. Does capital gains tax still apply? Yep. But Ben, 2 years, that's the usual.
Yeah, normally you'd have 2 years from the date of death for that not to be a problem. If it's moved on past that, then there's, you need to consider that for Australian tax.
And a question here for Jeremy. I've heard there are a number of banks changing their lending policies, with the latest one happening this week. Mate, do you want to run us through that one?
Yep. So I've got so recently I had a letter come. They've increased their LVR, so they were at 60%, which is quite conservative now, gone up to 80%. And one of the key there is for the listeners that are based in UAE, they will service the loan looking at your income after tax. So they'll still shade it back, which most lenders will do, 20%, but they'll actually acknowledge the fact that you're not paying any tax on your income over there, which allows you to have a higher borrowing capacity, where a lot of lenders will still apply Australian tax rates against your overseas income. So if you're in Dubai, then that's not a true reflection of what your borrowing capacity is. For the expats living in the UK or the US, where it's sort of a like-for-like tax rate, it's not a big difference there for those guys. But that's a big change. So that would allow the expats over in that region to be able to get access to more capital, particularly if they've got existing property and they want to get some equity out. Perhaps they want to get cash out to do some renovations on the property, uplift the value of the property, get new tenants in there at a higher rental yield. There's often a lot of things people want to do with their property. They've had it for a number of years. That's going to be a great positive change that we can access.
So Bank West, keep an eye out for them. Another question here from Anonymous. I have a Vanguard and pension plan with the university that I work for. Once I finish my contract, I'll have a large amount of money that goes back with me to Australia. What will be the tax consequences of sending a large amount, and any recommendation as to where I should put it? So I'll touch on part of this, and Ben, do you want to take the other part on the tax side of it? So Anonymous, there's a lot of options you can do with it. It depends on liquidity at the end of the day. When it comes to what you choose, super is a fantastic tool for retirement. If you think about a tax-free income, zero capital gains tax, zero income tax for a 30-year period, essentially another career. That's the appeal of super. However, obviously, preservation rules stipulate that you cannot get access to that before the age of 60. You virtually have to roll up with your own death certificate to try and get some money out of that. So if you require access to those funds before then you might look at a staged approach, and you might look at an investment account, whether it's in joint names or in a family trust or all those sort of vehicles. It really depends on your liquidity requirements, and it depends on your investment horizon too. If it's for a short amount of time, then you're going to buy a property, then you want to focus on cash. So there's a lot of moving parts to that. Ben, do you want to talk about the repatriation of capital?
Yeah, sure. I mean, there's a whole bunch of things I'd say in relation to this. The taxation of the drawdown of this could take many forms depending on, how that income is characterized. So if it is an actual pension and you've got a double tax agreement with that particular country, and that dictates how that pension is taxed, then that will be relevant to how you need to consider this. Often pensions will be taxed only in one country and not in the other. If it's a lump sum, it's likely taxed different to a pension. And so every double tax agreement is slightly different as well. So you need to be really considered based on where you're coming from, what type of plan it is, really analyze that plan, make sure that you've got it in the right buckets for analysis. Then what we'll typically find is that a lot of retirement funds from overseas are treated as foreign trusts and taxable based on the distributions that come in, less any corpus of those trusts. If it fits in that category, that's how that may work. So contributing to super is a great way to try to mitigate some of that, and repatriating over in parcels also can also help. But at the same time, you need to consider a global position as well, because, you know, for countries like the US, if this person remains is a US citizen, remains a US citizen, then the IRS want to keep their fingers on any sort of global income typically that is payable to them. So things like superannuation accounts may actually have adverse tax implications for the US. So the short answer is you really need to get specific advice on the ins and outs of the specifics of your situation before we can give you a proper answer on this. But those things I mentioned are probably the key things to sort of work and understand.
Definitely. Okay, next question. I'll throw this over to Jeremy. I've had a same well-serviced loan for 10 plus years, but the bank probably doesn't know I'm a non-resident. Have you seen any issues with lenders pulling loans for this reason? So I'm assuming they haven't given them a foreign address and they don't know that they're a non-res.
No, I mean, banks, when you look at the contract of a mortgage, that there's lots of terms and conditions within there. So I'm sure they would be within their right to pull it if they wanted to. But from a practical point of view, I've never seen a bank pull in a loan because they've found out that someone's now overseas. For example, I've had clients that have taken out a loan with, say, ING when they're in Australia. They've gone back to ING now that they're living overseas for additional funding. ING said, we can't help you because we don't do foreign lending, but they're happy to keep that existing loan in place. So no, I haven't seen that. The main thing there is just to make sure you maintain the repayments, because obviously if you're in arrears, then they can call the loan in that point of view, but it's really set and forget. And then they had a follow-up question there around transferring money into Australia. So I think one thing just to be mindful of is just making sure we've got an offset account set up. A lot of people just put money straight into their redraw, which is fine. But if you put the money into your redraw and then you pull that out for a different purpose, let's say it's not related to that loan, then you can cause a bit of a tax deductibility issue. So just having those funds from overseas sitting in an offset account, which still reduces the interest that's being charged by the bank. So net still having the same impact on your interest charge over the year. But then you've got that flexibility that, let's say you had $20,000 sitting in your offset, which is a savings account linked against your mortgage, and you decide to take $5,000 out to go on a holiday, well, then that's not going to cause a tax issue versus if you put it straight into a redraw.
Yeah, very good advice, mate. We see that all the time, and people interchange those two phrases with redraw and offset all the time. And what a lot of folks probably don't realise or know, that Jeremy used to be a former accountant before he saw the light. So Ben's still trying to get out, but Jeremy saw the light, and hence why he can talk on two sides of the tax implications of a mortgage, as well as obviously how to secure the mortgage. Next question from Michael. I'll answer this one. Can expats have an SMSF? The short answer is no. And I know I don't appear on a lot of people's Christmas cards because I say that, but to me, the reason I say no is very rarely do we see any scenario where it works. And I'll tell you, the only scenario where we do see it work is when someone moves overseas, not just makes their friend, brother, parent a trustee of their SMSF, but they actually merge them together, and that greater than 50% of the value of the account relates to that Australian resident trustee. If you look up Section 95 of the Income Tax Act, you can fill your boots on this one. What it virtually means is if you just put someone as a trustee and give them power of attorney, you're still having that ability to hire and fire. You can turn that power of attorney off tomorrow from overseas. The control, the central management control, which is imperative to making sure an SMSF is valid, has to be in Australia. That's why someone with an economic interest in your SMSF has to be in Australia. Otherwise, it's rubber stamping, and we do see the ATO take exception to this. And the penalty, it's not just a smack on the hand. The penalty is 46% of your balance of your fund for every year that you're non-compliant. So if you don't fix it in the first year, then they get you another year, and 46% plus 46%. So it goes on from there. We do see situations where people holding property, for example, who it's very difficult to wind things up quickly. We have actually seen times when the ATO have been quite flexible with clients. They're saying, look, due to exceptional circumstances, we are trying to wind this down, but we can't do it within this 2-year window. Essentially, we have this rule called the temporary absence rule, 2-year window. From the time you live overseas, you really have to get things wound up. In saying that, I was on a call this week with a client, and the client was undergoing an audit on their SMSF by the ATO. And even though they only left 18 months ago, December, year and a bit ago, the ATO was demanding that she make it a small APRA fund today. And I said, go back and challenge them and say, you've got 2 years, you'd like to use that 2 years, because they're actually going to sell down assets and clean it up. Because making a small APRA fund is not as economical with a smaller balance as it is a large one, because they'll charge like a wounded bull. So I guess, Michael, the answer is, in probably 1 of 1,000 cases, I'll agree that an SMSF is applicable for an expat. And the other 999 cases, you can do far greater things for super now than have to have an SMSF. If you want to have a direct share portfolio, domestic and international, you do not need to have an SMSF to do that. Look at a wrap super fund. You can buy NVIDIA shares, you can buy Royal Dutch shares, you can buy ANZ shares. There's a lot of other options, but you don't have the headache of the trusteeship. You'll have a corporate trustee. You don't have to worry about CMC. That's not an issue, and you can have that peace of mind. Very rarely do I see a case where I recommend a client retain a SMSF. Another question from Anonymous. For the 50-day visit example Brett mentioned, where the concerned person was considered as a resident, what was the main cause? Okay, I think they're talking about that engineer in Dubai, aren't they? There, Ben?
Yeah, they were. That's right. So there's a number of factors. He had a family still in Australia, so wife, 4 children, I think it was. He had 4 cars registered in his name and kept them registered, and he did use them when he came back, even though they were really sporadic trips. Everything was kind of as he left it in Australia, and it seemed like the spending was reasonable for what was in Australia. So there was a number of different linkages to Australia in that scenario. But to be outside of the country for 310 days in this other country where he said he developed social and other ties, it's quite a harsh outcome. If you read the underlying tones of that case, there was some flavors of the judge not necessarily believing that the witness was a very good witness and changing his story a fair bit. And he also didn't help himself by having his employer withhold the tax. So it was an Australian employer, didn't do a variation to have them not report the income. He just came to the ATO after the money had already been sent to the ATO and then tried to claim it all back. So the ATO had full understanding about how much they were going to gain by objecting to this position. So he didn't really do himself any favors, but the court is independent, obviously, and looked at all facts and said, no, we think based on this, you're resident. And in his situation, he averaged about 50 days per year. So that was over a 5-year period. So he was outside of Australia for some time and still found that. So you want to be doing whatever you can to cut ties to Australia if you are looking to have a more concrete non-residency position.
No, I totally agree, Matt. I think living overseas with your family back in Australia, working for an Australian company, the word Australia gets mentioned too many times in his situation. And one thing we've always said to clients is when you are moving overseas, ask yourself the question, in my case, I'm based in Dubai, would an Emirati ... would an Emirati own a car in Australia? No, they wouldn't. It's a lifestyle asset. Get rid of it. Would they own a jet ski? No, get rid of it. And people go, oh, but I love that car. It's like, well, do you want to risk this or not? That's the biggest question. And sometimes it's the easiest choice to make when you sit there and ask yourself, would an Emirati own property in Australia? Yeah, and tons of it. So that's fine. investment assets are okay, lifestyle assets aren't. And in this case, it wasn't. And that actually relates back to that question we had earlier about the 180 days rule. You know, it wasn't a been, you know, people rely too much on that. This guy only spent 50 and he still got done. But there was a lot of other stuff there too that was a mitigating circumstance. Another question from Kylie. Is there a risk to non-resident status if holding a large sum of money in an Australian bank account as a mortgage offset? I'll give you a bit of an answer, then I'll throw this over to Ben. The question is, Kylie, from a tax point of view, is not really an issue of it as such, because it's an investment vehicle, no different to shares or term deposits, that sort of stuff. It's different to having cash just sitting in a separate bank account. Where we see people go wrong with this type of strategy from a financial point of view is if you hold too much money in offset, you are killing your largest tax deduction, which is interest cost on a property. And we've seen people who had, you know, almost 100% fully offset mortgages, and they're complaining about paying tax. Well, because you've got no tax deductions, because you have no interest expense. So putting money in an offset account is not always the answer. And also, too, if it's a short-term thing as a non-resident, works. As a long-term thing, it doesn't. You don't get the benefit of compounding returns on that money. If you've got money sitting in an offset account for 10 years, you're only getting the rate of return of what the interest rate is on that day. Whereas, let's say, for example, the mortgage is 7%. If you put that money into buying shares, you bought $100 worth of shares, that gave you a 7% return. Next year, when that money gets reinvested and gets another 7%, it's a 7% return on $107. And that's the power of compounding. Whereas offset accounts, you don't get that benefit. It's just a 7% offset at every single time. So hence why I say it works well in the short term as a non-resident, works great as a resident, because obviously, loan interest isn't tax deductible when it's a principal place of residence. But don't manage your mortgage as a non-resident like you would as a resident, because sometimes you are losing the opportunities. Ben, I'll throw it over to you about tax and considerations of offset accounts.
Yeah, look, it's not impossible for the ATO to infer something towards residency on that. I would say it would be a small factor in the whole scheme of things. I can think of one case where it was considered, Snedden, which is I think 2009 case. He had lots of other factors pointed towards residency. He had a home that he had vacant that was left available for him to come back whenever he wants. He started a relationship with somebody in Australia. So by itself, I don't think it really is a major concern. It really has to tell the story that you are contributing so much of your income that you're really not living in the country that you're in. If it's surplus funds and you're living a good lifestyle, I wouldn't be worried about it. It's an investment decision, as Brett says.
And the next question from Anonymous. I missed Jeremy's answer regarding borrowing capacity for expats. The question, does working in Saudi/Qatar (no income tax) affect my borrowing capacity in Australia positively or negatively? Jeremy, do you want to jump on that there? I think he's just stepped away from the screen. So I'll just start off answering Jeremy's question. The answer, it doesn't.
Oh, sorry. Yep.
Sorry. Yep, you're there. Okay, good.
So in terms of positively or negatively, it really comes down to the lender. So there are a number of lenders that will recognize the fact that you're in Saudi or Qatar earning tax-free income, and they'll service the loan using the net of tax. So it will allow you to have a fairly accurate representation of your borrowing capacity. A lot of lenders with those countries will apply Australian tax rates on your income. So with those lenders, I guess negatively, it'll have a negative impact because of what we can borrow. Those lenders will be much less than what you're actually taking home.
No, good answer. Question from Imran. Are losses on the maturity of units purchased as part of a property development syndicate included in the calculation of taxable income? Additional information which may be relevant: the interest income from the units has been taxed historically as part of taxable income at 10%. Oh, okay, that's an interesting rate of withholding. But Ben, that's yours, mate.
Yeah, so look, if you've got units in a trust, then that's a CGT asset. So you need to work through the CGT events that come from that. But if those units ended then you've got the CGT calculation you need to work out. So effectively you are, if the whole thing is a loss, then typically that will generate a capital loss unless the work you're doing is on revenue account. So you need to dig a bit further into the transaction, but the losses are considered for taxable income effectively. It's just whether they're revenue or if they're capital losses.
No, good answer, mate. Another question from D. Wong. Is there any tax for full withdrawal from India Provident Fund and repatriate to Australia in the case of an Australian tax resident? That's an easy one, Ben.
I'd expect yes. It should be, in my view, considered a foreign trust is what I'd expect. So the typical taxing time is when you draw down on those funds. Again, as mentioned, they will likely be reduced. The taxable income amount should be reduced by any corpus of that trust. So any contributions made to build up a balance within that fund. So yes, we need to have a look at what constitutes that fund balance and work out the taxable amount.
Okay, and I think we'll leave this as the last question today for the folks out there. Jeremy's in Sydney and Ben's in Adelaide, so it's a long night for them, and we'll let them go after this one. In Dubai here, it's only 2 o'clock in the afternoon, so we've got plenty of petrol still left in the tank, but the boys are having a long day. Mate, this one for you, Ben, lucky last. If you are one of the directors of an Australian company but not claiming an income, will this impact your residency?
I would say try not to have directorships when you're trying to claim non-residency. It is quite a strong link in my mind. If you're a passive investor, that definitely helps. But running a business that's an Australian-based business is quite a strong factor in my view to having links to Australia as a resident. So I would say avoid it. It's not a good look, I think. But you need to consider everything as a whole. So yeah, that's probably enough on that, I think.
Fantastic, guys. Well, look, we'll wrap it up there. Thank you very much to my co-panelists, Ben and Jeremy. Hopefully everyone enjoyed as much as you can enjoy finance webinars. It's not exactly the most exciting thing, but hopefully you found it informative. We'll be sending out a copy of the slides as well too, if you want to review those at a later date and time. If you have any questions, as you can see, we're quite personal. We're not going to bite your head off. So if you do have questions relating to managing your finances, you hit us up at atlaswealth.com on the contacts page, and we'll look forward to seeing you guys in the next webinar, guys. Thanks very much.